When a REIT swaps a $2.5 billion office tower for a $3.9 billion retail icon, the market cheers the trophy, but ignores the interest coverage math. If your retirement funds are tracking these moves, you need to know if you are buying a yield-accretive masterpiece or a gearing-heavy headache. Today, we audit the true cost of these billion-dollar pivots. I have been watching this latest wave of asset swaps closely. The numbers that finally made me sit up were the pro forma gearing figures buried in the fine print. This is one of those pieces where the headline story and the balance sheet reality point in two completely different directions. So let us do what the headlines will not and go straight to the debt. The broader market gives us our baseline. The STI broke the 5,000 psychological resistance, shifting focus to the sustainability of this bank-led rally. The 6-month T-bill sits at 1.47%. The 3-month SORA at 0.88% suggests rates are easing, which should provide some relief for floating rate debt. Yet the iEdge S-REIT index remains the laggard of the 2026 rally, down 1.30% year-to-date, which tells you the market still has questions about leverage and income sustainability in this sector. Let us start with Capitaland Integrated Commercial Trust. The forensic verdict here is clear. This is a trophy swap that has pushed gearing through the forensic ceiling. The trailing yield of 4.85% passes our hurdle. That part is fine, but pro forma gearing hits 39.2%, breaching our 35% limit. And more critically, the interest coverage ratio drops to approximately 3.1 times. That breaks our 4 times structural threshold. Here's exactly how that happened. Divesting Asia Square Tower 2 to acquire Paragon is a massive capital rotation, and the yield does clear the hurdle. But Suntec REIT maintaining gearing above 42% is not a defense for Capitaland Integrated Commercial Trust running a stretch balance sheet. If debt costs rise by 50 basis points applied to a 39.2% gearing base, that already strained coverage ratio gets worse. For a 55-year-old professional in Jurong approaching retirement, this acquisition is a capital call risk dressed as a retail upgrade. The yield passes, the balance sheet does not. The Paragon acquisition is not a bad asset decision. Orchard Retail has genuine long-cycle demand. The tenant mix is institutional grade. The forensic problem is the price of entry. At 39.2% pro forma gearing and an interest coverage ratio of approximately 3.1 times, this trust has purchased a premium asset with a balance sheet that now has almost no shock absorption left. The 4.85% yield clears my hurdle, but a single rate cycle turn or a dividend cut from slowing retail reversion would erase that margin. Trophy assets do not exempt a REIT from arithmetic. Now the hospitality sector. For CDL Hospitality Trusts, the forensic verdict is this. Modest cancellations are just the trailing indicator. The real risk is a near-broken interest coverage ratio. The 5.75% yield passes comfortably, but that number is doing significant work to disguise a gearing position of 40.0% and an interest coverage ratio approximately 2.0 times less than half our forensic floor. At 2.0 times, this is not just in breach territory, it is in distress territory. Management says the Middle East conflict impact is not material to date, and I will take that at face value. But the numbers tell a deeper story. Far East Hospitality Trust maintains a cleaner balance sheet at this point in the rate cycle, a sanctuary alternative without this leverage overhang. If conflict impact extends and floating rate debt costs move upward, that yield gets tested quickly. There is almost no operating buffer left. For a 60-year-old retiree in Tampines managing SRS drawdowns, receiving yield from a trust where interest expense already consumes approximately half of operating income is a structural warning for tomorrow, not just a number on a screen today. The framing that Middle East conflict exposure is not material to date is a baseline, not a reassurance. The forensic concern is not this quarter's cancellations. It is what an interest coverage ratio of 2.0 times means when the next demand shock arrives. And hospitality is exactly the sector where demand shocks arrive without warning. At 40.0% gearing and coverage at half the forensic floor, the 5.75% yield is earning its premium. The question is whether that premium compensates adequately for a balance sheet with almost no room to absorb a bad year. On to agribusiness. Wilmar International is a classic yield trap. Single-digit revenue exposure gets the headline, but failing yield and borderline leverage are the forensic reality. At a share price of $3.89, the trailing yield of 3.60% breaches our 4.7% threshold. The net debt to EBITDA ratio sits at approximately 5.0 times, exactly on our yellow flag boundary, offering no forensic comfort. Wilmar notes only indirect impact from the Middle East conflict. a single-digit revenue share. Yet Golden Agri-Resources offers higher trailing yields, which highlights Wilmar's premium pricing relative to its deteriorating income metrics. Rising logistics costs through the Suez Canal corridor pose a margin compression threat to an agribusiness model already running thin. For a 45-year-old HDB owner in Ang Mo Kio using dividends for family expenses, earning less from Wilmar than a passive CPF special account balance returns is the exact forensic definition of a yield trap. And finally, Centurion Corporation. The verdict here is a strategic neutral. Mining tailwinds in Australia simply do not fix a yield that fails our test by 232 basis points. Gearing is very healthy at 26.4%. The interest coverage ratio of approximately 5.5 times passes comfortably. The problem is purely on the income line. A 2.38% trailing yield severely breaches our minimum requirement. Centurion is expanding into key worker accommodation in Western Australia for the fly-in, fly-out mining workforce. The balance sheet is the cleanest in today's audit, but broader industrial and logistics trusts offer significantly higher income for comparable exposure. And occupancy in these camps is acutely sensitive to iron ore price cycles and China's steel demand calendar. For a 65-year-old drawing CPF life in Toa Payoh, this means trading an income sanctuary for speculative key worker growth that has not yet appeared in the dividend line. So what is institutional consensus saying? On Capitaland Integrated Commercial Trust, bank coverage centers heavily on the orchard recovery narrative and the massive Paragon footprint, seemingly pricing 39.2% gearing and 3.1 times coverage as acceptable risks. I do not. On Wilmar, coverage cites limited Middle East impact as a reason to stay invested. But when you run that 3.60% yield against the 4.0% CPF special account sanctuary benchmark, you arrive at a completely different conclusion. Here is where the income spreads actually land. Against the 6-month T-bill at 1.47%, Capitaland Integrated Commercial Trust at 4.85% creates a risk premium of 3.38%. CDL Hospitality Trusts at 5.75% widens that premium to 4.28%, but those premiums must be weighed against their respective structural breaches. A higher premium means nothing if the underlying debt structure cannot sustain the distribution that generates it. Our minimum yield hurdle remains strictly at 4.7%. I apply a conservative floor of 3.2% plus 150 basis points of mandatory risk premium. We audit for the storm, not just the sunny day. The 6-month T-bill sits at 1.47% right now, but I do not lower my standards to match a temporary market dip. My floor stays anchored because sanctuary assets must be able to withstand a return to long-term average rates, not just the current easy environment. If you want the full forensic breakdown before the market prices it in, the elite investors community gets 0-day access to every deep dive and watchlist trigger. We track the numbers when they still matter, the full red zone watchlist, and institutional grade cheat sheets, so you stop being the exit liquidity and start being the analyst. It costs just $9 a month. It costs just $9 a month. Less than a kopi and kaya toast set at Raffles Place. The link to join Iggy's elite investors is in the description below. Today is a day of billion-dollar pivots and geopolitical non-materiality, but the forensic story sits in the balance sheet columns the headlines skip. For Capitaland Integrated Commercial Trust, the Paragon acquisition is a high-conviction retail bet, but at 39.2% gearing and 3.1 times coverage, the fortress has been breached to fund the upgrade. The yield passes, the structure does not. For CDL Hospitality Trusts, an interest coverage of 2.0 times means interest expense already consumes approximately half of operating income. Hospitality REITs with broken coverage ratios do not get the benefit of the doubt. For Wilmar, a single-digit conflict impact does not justify a 3.60% yield that is beaten by a passive CPF special account. With net debt to EBITDA sitting at the yellow flag boundary, this is a clear yield trap. For Centurion, the cleanest balance sheet in today's audit, but the worst yield, pass-on structure, clear fail on income, firmly at a strategic neutral. Imagine a Punggol investor trading HDB stability for agribusiness or premier malls, only to find dividend yields running below what a basic fixed deposit returns. When the headline is a trophy acquisition, the fine print is usually the debt. The market prices the asset. I price the balance sheet. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. If you want to see them before the crowd does and utilize our 7-day embargo window to position your portfolio, join Iggy's Elite Investors using the link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.